Hi, JJ here again with The Art of Value. Welcome. Well, Chris Mayer, the author of 100 Baggers, that's stocks that return $100 for every $1 invested, recently gave an interview with TIP, the Investors Podcast, which I'll link to in the description, and I encourage you to watch the whole thing. But I'm going to summarize it here, cut it down to some essentials of what he said, looking for these 100 baggers. Is it possible to predict which stocks will return 100 to 1 over time? Well, he's looked deeply into it, written the book, of course, done a lot of research and implemented it into his own investing. So let's see what he's got to say. Let's get straight into it. Your time is valuable. He's discovered that the 100 baggers took on average 20 to 25 years. Some were quicker than that, but most 20 to 25 years. So you have to be invested for a long time, and they have to compound capital for 20 to 25% a year, which is pretty rare. So really good returns on capital and growth, he says. For the company, we have to look for companies with strong growth and great returns on capital. He says it's best to look for companies with moats, as Warren Buffett said, a moat or a sustainable competitive advantage, and an entrepreneur behind driving the company forward. We all know companies like that. He said, mentioned Steve Jobs, but say Elon Musk, Jeff Bezos. There are numerous companies that have been 100 baggers or 10x so far or more that have a strong entrepreneur behind it, a founder leader, which is important. It's something that I definitely favor. I look for in my investing as well. It often tends to be those sorts of companies with people with a lot of skin in the game, somebody driving it, a founder driving it forward. If you're getting value out of this episode so far, please remember to like on YouTube or Rumble to help spread it to more people. Thanks. Talking about valuation, the price we pay for it when we buy a stock. And so this is a difficult one for value investors who are used to trying to buy really cheap stocks. But he says quality businesses often are at a premium. And if you look at the quality businesses that have compounded over time, they often do sell for a premium value. They're very rarely on sale or substantially on sale, but it does happen. So he's saying you can wait, or you don't have to wait. You can buy, and then if it gets cheap, you just buy more, because it does take 20 to 25 years. If you're a long-term holder, you get more than one bite of the apple. Mentioning Apple there, Apple has been cheap. When Warren Buffett did buy it, he waited. He bought it in 2016, 2017 when it was cheap, but he said Terry Smith there. You can see Terry Smith's annual video. He does talk about this. He proves that if you go back in time over these big compounders, you don't have to buy them necessarily cheap, because there's such good companies that they do compound and you still do well over time, even if you don't get them at a really cheap price. More talk on a moat or sustainable competitive advantage. He talks about it being important to have it for a long time, being sustainable, meaning over a long period of time, and being able to beat out the competitors, or having something special that is better than the other companies in the sector or other companies that might try to attack that moat. So moats can deteriorate over time, but looking for that something special. Another point is that you have to be right about the business. It's all very well as investing, saying it's going to be 100 bagger, predicting that, but you do have to be right. So putting a lot of research in, researching that it does actually have a moat or a sustainable competitive advantage. This is a simple concept, but I think a lot of investors do miss this, that winners keep on winning. It's easy to forget, easy to think, oh, you've missed that because it's gone up X amount, it's gone up 5X, 10X already. But these winners, these 100 baggers, keep on winning for a long period of time. If you look at even Berkshire Hathaway, a company like that, or many of the great 100 baggers, if you got in and you thought you were late, and you weren't late, because they kept on going. Winners keep on winning. And as he said, you get more than one bite of the apple. It's not too late for these great quality companies that compound for a long time. Management with skin in the game, meaning that management or the CEO, the founder, has a lot of shares, a lot of stock in the companies, because it's important when it's bad times, especially. You'll see good capital allocators buying back their own shares, buying more shares. We've seen that with Warren Buffett recently, with Berkshire Hathaway buying back their own shares. But just the importance of having a high ownership from management, and in particular the owners, the founders of the company, if they're still there. If you've got a CEO that's just a hired hand who gets paid a lot but doesn't have share ownership, they're not going to work as hard, he thinks. And I like to see this as something that I like to see too, big high ownership from a founder operator for a high compounder company. He was asked about his own fund, his own investing, and he says he looks for those high returns on capital. Comes up again and again from many great investors, including Charlie Munger, Warren Buffett. Terry Smith likes to see high returns on capital employed. High returns on invested capital, all the returns on capital, really important. One of the most important things. One of the things he says he's changed is in the book. If you read it, and I do encourage you to read the book, it's an excellent book. I'll put a link to it in the description, a referral link. Do read it if you haven't. It's become a favorite in the investing community. So he talks about market cap. He talks about, in the book, being below a $2 billion market cap, even below $1 billion is best, and he's changed that. And if you look at his portfolio of 10 stocks, he does have some quite high cap stocks in there, even though he said that he bought them earlier. But the theory being, if they're small, it's easier to compound. And Monish Paprai said this too. He likes it under 5 billion or even as small as possible, because they're easier to grow if they're small. If they're mega cap, large cap, it's harder to grow. Trees don't grow to the sky. And so he's changed that a bit, but I do think looking for smaller caps is best. Perhaps more risk because they haven't won yet, as Terry Smith said. He looks for companies that have already won, old companies in general, but companies that have already won. So smaller companies not necessarily won yet, perhaps a bit more risk. So more on return on capital. He says he looks for 15% compounding. Of course, companies can get that 1 year, 2 years, but compounding for a long time, 20 to 25 years at 15% or more. As far as return on capital employed goes, an important metric, I think, and Terry Smith has said so too, Charlie Munger. So the average for the S&P 500 company is about 15%. So anything above that is sustained is very good. Some are 20, 25 if you see a company like that with return on capital employed, return on invested capital that's really high. That's interesting. That would be an interesting company to look at, and chances are it's not going to be cheap. There's a question about being comfortable with a concentrated portfolio. He's got 10 stocks. He likes to keep to 10. Other investors like more, like the Motley Fool style of investing, which is 30 or more, but a low percentage allocated. I tend to think that good investors, good value investors in particular, have fewer stocks because they really know what they're doing, they know analysis, and they're confident in their decisions. And so 10 is plenty. He said there, Joel Greenblatt is one of the best investors of all time, certainly in the last few decades. He at times had 5, 6, 7 stocks only and a high concentration. Also, Bill Ackman doesn't have many stocks. Buffett and Munger have accumulated quite a few stocks, but if you look at their positions, a lot of it's in the top few stocks. Look how big Apple is in their portfolio, but they really know what they're doing. So diversification is kind of for people who don't necessarily know analysis, or even just the S&P 500 index is where to go. But so the more research you do, the more investing you know how to invest, I think you're more comfortable with having a few stocks. For me, I've got 15, and I'm thinking they'll probably end up with 10 over time. Some of those won't do well perhaps, and I'd like to end up with 10 over time. Just 10, maybe less, but I think I'm comfortable with 10 to 15 at this time. And I'll leave a link to the full interview on the Investors Podcast. I'd encourage you to see the whole thing if you want to, and his book 100 Baggers. As I said, I'm going to leave a referral link in the description. Highly recommend you read that book. Investors have got a lot out of it. It's become a favorite in the investing community, and I got a lot out of it. Also, I'm going to leave a link up here on YouTube to the last video I made about 100 Baggers, which reveals Chris's 10 stock portfolio, what he thinks could be 100 baggers. That's all he buys these days, so well worth checking that out. And I'll see you next time.